Hello, everyone. Let's take a look at the unusual options activity tool. Now, by default, there are no filters on this other than we have a call type selected and they are OTM, out of the money. Then by default, what you see is a sorted list by amount descending. So the largest new positions are on top. And this is actually a great example that we can talk through here. We have two NVIDIA calls, both for the same strike, 150 and 150, but totally different expiration dates. This one is 11/22 in 24. This one's 1/17 in 25. Now look at the difference in price for the position. So this one is 1160 per contract, right? This one's 390 per contract. So if you buy one contract, that's $390. If you buy one contract, it's $1,100, but they're the same strike. So what's the difference here? Well, the difference is time. So with options, you pay for time. Time reduces risk. It gives you the ability to increase the position size. It gives you the ability to put on a little risk and get out of it if you don't think it's going the right way. So time, I love to pay for time, and I'm willing to pay for time, especially when we can avoid certain things that you need to be aware of in the options world, which are primarily binary events. Binary events can destroy a position real quickly. So why is this one third the price? Well, let's look at the chart here on NVIDIA, and we can get some clues. Well, first of all, it's quite obvious. We're talking this Friday. So today is 11/18. This was put on Friday 11/15, $63 million. Pretty large increase in size, right? So before that, there were 61,000 contracts open. Someone increased that by 165,000, right, for $63 million, betting that NVIDIA closes over 150, or at the very least, the price of the option increases, right, as we go into Friday. And maybe they'll get out of it before the binary event I'm about to show you. But look, here's NVIDIA. So currently we're at $140. So we need to move up $10 to be in the money. However, look down here. Here's our binary event. So earnings is on 11/20. That's on this Thursday. So binary event, you're not paying that much for it. If you get it right, this can be huge moneymaker. But like I said, I'm willing to pay for time. I don't need to get rich Friday. I like to get rich over time with lower risk. So if I'm going to look at a 150 strike on NVIDIA, I will gladly pay that 1160 and give myself 3 months, or I'm sorry, let's see, what are we at here? So that would be 3 months. So okay. By default, we're looking at the highest amount being placed into a new position. In this case, 63 million, right? A lot of this can be noise or misleading though, or it involves a binary event. So they've got a deal here, right? So what I like to do though is filter by market cap. And I go to $1 billion companies to $10 billion companies. And what I tend to find there are much better deals, much better charts, and a lot less room for manipulation. So I at least want to go out 30 days. So let's select 30 days. So we're at $1 billion market cap to $10 billion market cap. Let's go ahead and look at what we find here. Okay, so again, default sorted. Oh, you know what? I put in a larger market cap. That's totally fine. I love X. I hold X. I've made a lot of money with X. So someone put down $8.6 million that by January 17, X is at or above $45. Now, they're going to get capital appreciation on this. Look at how cheap that is, $239, right? So you can buy these at $239 and sell them in December, for example, assuming X goes up. So then our next question is X going to go up? Well, that's a question of probabilities and the chart configuration. So we've got time on this one. You know, we've got until January 17. We're looking for $45. We're currently at 38. Now we do have a nice big wick here that could get tested. So these are the type of things I'm asking myself when I look at the chart. Is this peaking formation going to bring it down into this range and deal with this candle here until it does bounce? Well, let's just picture that in our head, what would happen here. So, okay, if we do come down here, well, we're getting to end of the year, 1220, right? Oh, I went a little far. So 1220. So let's say it bounces somewhere around here, right? Okay. Nope, I don't think we can get back up to 45 if this does play out to the downside. So right off the bat, I can look at the chart and tell you, not interested. Not to mention small size increase, and it's very cheap. That tells me that we're probably not looking at a good bet here. So let's keep going through the list. All right, so we've got CLF. Now, I also hold CLF, and I've made a lot of money with CLF. They are a steel producer, just like X is a steel producer in the United States. We're looking for the 17 strike by Jan 17. We've got a 535% increase. Now let's look at their chart. So CLF. Okay, 17 strike. We're at 11 right now. But look at this chart configuration. This is what I was thinking about when I was looking at X. And you can see why it was so cheap. So look, we've already moved up, which expanded and increased the price of the options, and we pulled back. So we're getting cheap time right now because of this pullback. Nobody thinks it's going to happen. But look, we came back to a previous point that had a wick and bounced. We're double bottoming on it. Now my likelihood chance of moving up from here is significantly higher. And I need to get to 17. That's a bit of a stretch. So 17 by January. But, do I really care if I get to 17? Absolutely not. I just am looking to make money on the expansion of price. And look at how cheap these are, 52 cents. So $52 per contract. So if someone put 3.7 million down, are they hoping to get shares, call away shares by January 17? Probably not. They just saw the fact that these were super cheap. They're getting cheap time. And they said, okay, I'm willing to put that down. And even if we only get up to the top here at 14, let's say, that the price of this option is going to go from 52 cents to, let's say, $1. So you just doubled your money, and you did it by sometime in December. I mean, you can also think through some macro stuff here too. So CLF is a steel producer. We've got a new administration coming into the U.S. that's very steel friendly. They want to do it in the U.S. So I love the chart setup. I love cheap time. And I see someone else noticed it too. I'm going to go buy one of these contracts and see what happens. So that's how I'm using this tool. And I'm not joking. I am going to buy one of these, and we're going to see what happens with it. So that is sum total of how I'm thinking through unusual option activity. It's very easy. All you need to understand is the time factor. That's the third dimension of pricing in options, which is very different than buying stock, right? There's no time factor in stock, other than opportunity cost, right? You could have bought something else. But the third dimension in the option world is time, and time affects price. So think through it that way. Check the chart. We don't need to get to the strike date. We just want appreciation on that option. So if you have any questions, please support@tradecanary.com. If you have suggestions on how to advance this tool, we had a user ask us for an export to CSV so they could take the data and put it into their own system. And it's not just taking this page, right? It's taking all 7,224 pages when you do the export. So please, if you have ideas, suggestions, let me know, and we will take it under advisement. Thanks for listening.